While President Donald Trump often touts a strong economy, the latest job data tells a more complicated story. Beneath the claims of resilience, the labor market is showing signs of fatigue. Rising joblessness and uneven hiring point to a slowdown that is becoming hard to ignore. The latest data suggests employers are still adding jobs, but not fast enough for broadly enough to offset growing pressures across key parts of the economy. Federal cuts, policy uncertainty, and disruptions caused by the recent shutdown have all blurred the true health of the job market, raising questions about how durable the data really is. Digging deeper, the weakness appears structural rather than temporary. Job creation remains concentrated in a few areas such as healthcare, while goods-producing industries like manufacturing and transport continue to shed workers. Wage growth is cooling. Long-term unemployment is creeping higher, and lower and middle-income households are feeling the squeeze from persistently high living costs. At the same time, consumer spending is holding up, but largely because higher-income households are still spending, masking the growing strain on the broader workforce. Economists warn this uneven recovery risks deepening the divide between sectors, regions, and income groups. Peter Schiff, chief economist and global strategist at Europa, has said, and I quote, "The November jobs report confirms a weak labor market. The U.S. economy is teetering on the brink of the biggest economic crisis of our lifetimes," unquote. He's also said gold and silver prices skyrocketing to new highs will ultimately pull the rug out from the U.S. dollar and treasuries, sending consumer prices, bond yields, and unemployment soaring. The influential strategist also added that the first casualty of the gold and silver surge will likely be Bitcoin. Before a US dollar crash, we will likely get a Bitcoin crash, and this will surprise Bitcoin holders who bought Bitcoin to protect themselves from a dollar crash. They jumped from the frying pan into the fire. For the Federal Reserve, the data adds complexity rather than clarity. The central cut interest rates by 25 basis points last week. The idea was to support a labor market that is losing momentum, even as inflation remains above the Fed's 2% target. Policymakers currently project just one rate cut in 2026, but further signs of labor market weakening could shift that outlook. At the same time, economists caution that shutdown-related distortions, immigration changes, and data revisions mean the numbers should be interpreted carefully. For now, the latest jobs report is unlikely to settle the Fed's internal debate on jobs versus inflation. All right, let's get a perspective on what this data really means. We are joined by Mr. Mark Brolin. He's a geoeconomic and geopolitical strategist and an author. He's live with us from London. Mr. Brolin, thanks very much for speaking with us on WION. Can I first start by asking you, how do you think this kind of a job data reflects the American economy? Sure, the Trump administration has been, blaming conveniently the fact that immigrants are snatching the jobs of the locals, but is it that simple?
No, it's not. And of course, it's very concerning. And I think Peter Schiff is very right in many of his core views, including his views on the high levels of debt and persistent deficits. That's a major problem. And I think one of his greatest points is also that monetary policy is a big problem. He's saying famously, but not so many others, that we never had the reset following the 2008 crash. And that is a major problem, because we just postpone or resettle the debt in a way. So we postpone the problem. That's what he's saying. But then again, I think he's also leaving out a couple of the upsides. And I think one of them is that technology tends to trump politics. So you can make policy errors and still be lucky if you're politicians. You can be really clumsy, actually. But if you're lucky with the timing, and we are now facing the perhaps greatest innovation era ever. And I think that will make up and perhaps even bail out the politicians if growth starts moving in a positive way, which it probably will in not so in the near future, I think that will actually bail out the politicians in some ways.
But Mr. Brolin, here's where my doubt lies. While we keep talking about how AI integration is one of the biggest concerns in the market, is AI that reliable that companies are completely depending on artificial intelligence and technology to replace humans? Because they're not error-free yet, completely 100% error-free.
No, absolutely not. And I think, that's a great question. That's $1 billion question. And I think many of the AI companies also will go bust, as always happens during all technology revolutions. But the big difference from this technology revolution and, for example, 2001, is that Enron, which was the key company in 2001, that was sort of a story company. It was built on the promise of future returns. And there were no returns. So it was shallow. When sentiment crashed, the company crashed as well, and then we had a proper crash. This time, the big difference this time is we still have lots of promises, but the key players like Meta, Microsoft, Alphabet, they are actually very profitable and have lots of liquidity. And they can go down 30, 50% and still not run into solvency problem. And I think that's the major difference. And I think what the leverage or debt problem Peter Schiff is talking about, that is real, but it is in other parts of the economy which are not as important as Nvidia and all the big ones. And we will see market corrections, I think so, but I don't think we will see the biggest, as he's talking about, the biggest crash ever. But the market correction, I think, will come, and many of the companies you mentioned as well. Nobody knows how an era like this is going to play out. So there will be elements of trial and error. More companies will be unprofitable than profitable, and that's also typical. But the big ones will carry the rest.
And so, taking all of this into consideration, Mr. Brolin, what sort of signals is the Fed focusing on right now? Because we are, of course, seeing Donald Trump's pressure on Fed as well. As far as the priorities are concerned, where do you think Fed is focusing most right now?
I think the Fed will be concerned about all the numbers. The Fed is famously quite short term, so they look at the very recent data and not so much dynamics going forward, because in a way that's their job. So they will be short term. Team Trump is short term, and they will be short term as well. But they will be very concerned. So they will be hesitant to do as Team Trump is asking them to do and lower interest rates yet more. In that sense, they will do that will satisfy to some degree, I think, Peter Schiff, since he has been saying for a long time that the era of low interest rates has been going on for far too long.
And so, my last question to you, Mr. Brolin, do you therefore think, are you also of the view that the market is structurally errored, that there are structural reforms that need to be done and the Fed will eventually focus on them?
Yeah, absolutely. And I think there are two ways. Well, I'm not sure they will be focused on it, because I think structural reform, changes happen in two ways, either by reform, proactive reform, mandated by politicians, or market corrections. And usually it is actually market corrections. Politicians will talk about reform. Many will know that they will need to be made, but they will rarely do them, because that's not what happens on the short-term gladiator arena of politics. So it will be forced market correction. That's why I think some of the market corrections, some of these will actually be positive, because it will force corrections that has to be made.
Okay. All right. We'll leave it there. Mr. Mark Brolin, thank you very much for speaking with us on WION and sharing your perspective and simplifying for us what this really means for not just the American economy, but entire global economies as far as job data in US is concerned. Thank you very much.
Pleasure.